that all ecosystem types want to talk about, viewers, and we'll do it very openly and dispassionately, very balanced. We're going to get into the nuances tonight. Market sentiment has soured over the last year, with the Sensex and Nifty both taking a severe beating that has seen $1 trillion of investor wealth being wiped out here in our country. The conversation is no longer about Sensex touching the 1 lakh mark, but about what's causing the slide and when will it stop. After steady market rise and peak in September over the last 1 year, both the Sensex and Nifty, viewers, and you can see there was a peak of about 85,000, and that was around September, October of last year. So within about 6 months, it's lost about 12,000 points, the Sensex, viewers. And the Nifty has also tumbled, viewers, and you can see that. The Nifty has also lost about 4,000 points there. And that has also happened in the last 6-8 months. So after the peak of 86,000 in September 2024, the Sensex has seen a steady dip to a little over 73,000. Again, today it was in the red when it finished. As I told you about the Nifty also, viewers, which is the benchmark. The Sensex is the benchmark index, of course, but Nifty is the top performing 50 companies are listed there. That's why it's called the Nifty 50. Now, many explanations have been set forth for the erosion of investor confidence. Why, in such a sense, would people be wary now of blue chip companies? Nifty 50 shows that there is, again, very little confidence even in their prospects. We're constantly told that the Indian economy fundamentally is very strong. If that is the case, then what is going on? Why is investor sentiment, why is it flagging? Why isn't it mirroring their optimism? Well, some people have put forward some theories. Some people have said there's the global trade tensions. The announcement of new US tariffs has raised concerns about potential retaliatory measures and their impact on global economic growth. Then there's the persistent foreign investor outflows crisis that has gripped us. FII's net sellers offloading approximately 25 billion worth of stocks since September 2024. The FM says that we shouldn't worry about this because this is a sign really of a strong market where companies are finding that they can invest and make profit and then they book their profit. So we shouldn't really get upset. She said FII exit is profit booking, a sign that markets are giving strong returns. The Finance Secretary Tuhin Kanta Pandey said FIIs aren't leaving India, but they are shifting to US. They're not rejecting the Indian market, they're just reallocating their portfolio because the yields there are greater and the market therefore is more attractive. All emerging markets have witnessed FII outflow. India is not an exception. So let's not press the panic button. It's happening across the world. Then, of course, viewers, and this is a matter of side concern, weak corporate earnings, Q3 2024-25, saw several Indian companies reporting weaker than expected profit after tax earnings, viewers. Rising inflation and interest rates, increasing borrowing costs, dampen consumer spending and corporate investments, denting economic growth and corporate profitability, impacting stock market performance. Then there are geopolitical concerns. Reversals in the Russia-Ukraine conflict peace efforts have added to global economic uncertainties. People are now once again getting to a cautious, hedging their bets kind of mind frame. But many believe that the problem is much deeper and is not being addressed by the government. Is this a fact? Let's open up the conversation to informed analysis. Nilesh Shah, MD Kotak Mahindra Asset Management Company is there with us. Saket Mishra, an investment banker, is there with us. Ajay Bagga, market expert. Professor Santosh Mehrotra, an economist, is there with us. I want to first begin with people who believe that there is a greater problem. Let's understand that perspective first. Why is there a greater problem, Professor Santosh Mehrotra, than some of the things that I have pointed out, which are perhaps cyclical, can easily be altered through fiscal means, etc., measures, etc. So why is this really a deeper problem? It's a sign of what to you?
I never said you were putting words in my mouth.
Okay. No, I'm only asking.
Bigger problem.
Okay.
Yeah, that's fair enough. That's fair enough. It's good to be provocative to start with. Anyway, all I would say is that the market was way beyond what it could have been or should have been. We know this perfectly well. It was an overhyped market, and so it's correcting. That's all that's happening. It's a fairly straightforward development. Our market was extremely expensive. especially the small caps and the mid caps. I mean, everyone who knows this understands this.
Okay, so it's a market correction, nothing much beyond that.
That's
So
right.
let me bring in Mr. Bagga. Mr. Bagga, what do you put this down to? Simple profit booking, correction, or is there fundamentally more problems? I've been reading that some people are talking about the fact that there is a tax on what investors make, which is making it a bit unprofitable. The Indian rupee is weakening against the dollar, so profit off taking becomes that more expensive. So there are some people who are coming out saying those things, but those are easily correctable. First of all, let's identify where the problem is, Mr. Bagga.
Our markets made an all-time high in the last week of September. And from there, if you see the small cap index, it's down about 26%. The mid cap index is down about 23%. And the leading indices are down about 16%, Nifty and Sensex both. What were the catalysts behind this fall? One would be that the markets have had a great run for 5 years, and it was logical that there was some amount of fall coming, and it was looking for a catalyst. The big catalyst came with the China stimulus when $50 billion globally went into the Chinese markets in 2 weeks. And that made a jolt to emerging markets. India also started seeing outflows. Then came the US elections, the Trump trade, Make America Great. We saw the pickup in foreign outflows from India starting to catch up momentum. And then with Trump's election on 5th November, we saw that picking up further. Along with that, the September quarter saw the GDP number coming at 5.4, and we saw corporate earnings going down, while the markets were at all-time highs at very elevated valuations. So all this got together, along with a restrictive RBI policy, along with lower government expenditure. If you remember, September 30th, our fiscal deficit was still in a very healthy situation, meaning government was not spending because the budget only came by about July, and the capex expenditure, other government expenditure had still to catch up. So all those factors got together, global as well as domestic, into a perfect storm.
Yes.
And that caught momentum in January and February, where we have seen 100,000 crores going out of the Indian markets in terms of foreign outflows. Domestics have absorbed that so far, but markets have fallen. And that is basically the crux of the situation, that domestic and global situation got together, and we have seen a fall in the market.
Okay, so let me bring in Mr. Nilesh Shah. Let's focus a little bit on the domestic situation, Mr. Nilesh Shah. Now, it's interesting that this correction started happening after you had corporate earning results out. And that showed that perhaps consumer demand wasn't as robust as certain companies were expecting. Now, many economists like Mr. Mehrotra will tell you that consumer demand, the fact that it is flagging, is a sign of greater distress in the economy than anyone likes to admit. Then, of course, the GDP numbers also hit at around the same time. They were lower than expectations. And that's a signal that private investment was low. And there are some people attributing larger factors for private investment not coming in because they say at a fundamental level there's a problem. So how do you analyze these two trends? Falling
Indian
consumer demand and private investment, which hasn't ever picked up. Yeah.
Indian economy is so large that you can prove both sides. We neither disappoint optimists nor we disappoint pessimists. Undoubtedly, there is slowdown in consumption side. It's visible on the urban consumption. But thanks to bumper monsoon, the Kharif crop and Rabi crop are likely to be better, and that's supporting rural consumption. And that's reflected in tractor sales, that's reflected in rural FMCG consumption. Broadly, we are still the fastest growing major economy at 6.2%. And hopefully now, the below 5%, the 5-handle GDP growth rate is behind us. Growth rate will be 6% plus. But market had certain expectation, and those expectations market realize are unlikely to be met. as Ajay Bhai mentioned, whether it's related to geopolitics, whether it's related to economic growth, whether it's related to corporate earnings or rupee or valuation, those expectations become too heavy to bear, and which is why we are witnessing price correction. Now, the same thing can be explained in another way. In the short term, markets are like a voting machine. In the long term, markets are like a weighing machine where fundamentals prevail. But in voting machine, the flow of votes matter. And right now, FPIs are selling, and they are selling aggressively. When you can see that FPIs are on the sell side, why will you give them easy exit? You would like to buy at a lower and lower prices, and that is what is exactly happening in the market. They are selling aggressively. Buyers are buying conservatively, going one step backward at a time, and which is why there is correction, a much sharper correction in small and mid cap where valuations were excessive, little less correction in large cap.
So would you say, and let me come to the investment banker, would you say then, Mr. Mishra, that this is the right time to get into the market, or should there be a wait and watch? What should investors do? Because there are certain expectations that the market is obviously now beginning to factor in, that they won't be met. And I will discuss that with Mehrotra, who's the macro number man, and also with Mr. Bagga. But I want to ask you, what does the investor do?
So, I mean, the simple answer is the investors can continue to buy if they like companies with good long-term prospects. So, let's say, I'm not making any sort of recommendation, but someone like a Reliance or Unilever's India, which has long-term prospects growth and relatively safer. But I think in reality, Rahul, the retail investor in any case has to be extremely careful in a market like this because you don't want to catch a falling knife. I don't think it is fit for a retail investor ever to try and time the market. But beyond that, you'd use the term problem for the market. I don't think it's necessarily a problem. It's a simple story of every institutional investor looks for risk-weighted sort of returns on their capital, which means FX risk, emerging market risk of India versus, let's say, the US foreign exchange risk, the risk of where the markets are and where it's going to get in terms of upside. And I think it's a factor of all these things coming together, including some amount of over buoyancy on our stock. The second point, so therefore you've obviously seen a correction. But that correction, which you very correctly said, there's been larger correction in the small caps and mid caps than the large caps. That again is a simple illustration of the risk approach. Large caps have less risk, therefore they've corrected less. While the smaller caps clearly are more of a punter's game, and therefore you've seen larger corrections. So it's a simple second derivative of the market. So I think good stocks and the willingness to hold on for a period of time should be what is determining an investment decision, not necessarily trying to time the market. I think that's just the wrong strategy.
Okay. Professor Mehrotra, the markets have discounted certain expectations. What do you make of this statement?
Yeah, I guess the way that has to be read is that there is every expectation that the market is going to continue to correct, because we know, compared to the 10-year trend that has been available for the small and medium caps, those are still overpriced. The price to earning ratio on those are still high. I was looking at both the PE as well as the price to book ratio, and they still seem quite high. They are particularly high, of course, if I remember correctly, they're particularly high on both small and medium caps, and those will continue to correct. At what Nifty level will it bottom out? The consensus that seems to be emerging now is that it will begin to bottom out, between 20 and 21,000. It's at 22,500 just now. And that's primarily because the price to earnings ratio will be back to trend average, 10-year trend average, and that's when the FIIs will begin to return. That's essentially what's going to turn the market. That's my reading of the situation.
Okay.
And that's when the DIIs should come in. And I mean, just a short, I'm no advisor, but I think the previous speaker, I think, put his finger on it, that you will not stand to lose money if you are invested long. If you're trying to make quick money, you're bound to lose money because especially if you do it on your own rather than through mutual funds. Very straightforward. It's a fairly well-known, established fact.
Okay, so let me bring in Mr. Bagga. Mr. Bagga, why has the Sensex underperformed so many indices of mid-sized and large countries, economies? Number one, and number two, what about all these taxes? You know, the taxes that we talk about on transactions, etc., that have been again sort of maintained in the budget. Many people are now talking about time perhaps to do away with it, to make this market a little more attractive to FIIs. So what's your advice? We're not earning much from them in any case.
Yeah, absolutely. I think that's the point. We have to see how much capital we really require. And we are a capital deficient country. We have to welcome foreign capital. And most of it, which is coming from sovereigns or pension funds or endowments, is very long-term healthy capital. I think that needs to be welcomed. And we used to have very good policies there. Over time, we have seen this creeping increase of taxes. And also, if you look at it from a domestic fund manager's perspective, it's a level playing field that the government has trying to make between domestic investors and foreign investors. But the fact is, for our infrastructure build out, we will require trillions of dollars of capital to come in. So it would be a good move if some relief is given there. But I would say tax is something that has not caused this capital to leave. More out of 900 billion, if 25 billion dollars has gone out, it's not so much right now. It is more episodic kind of exits that you are seeing. Various other issues. It's very complex to say in 1 minute, but various other issues come in. We have underperformed other markets, especially for the first 2 months. What Nilesh Bhai was talking about, I would say the economic bottoming has happened in September. Probably the corporate earnings bottoming happened in the December quarter. And by June, Rahul, what happens is the base effect starts coming in. We had negative print in 2 quarters last year. Now, this year, all of a sudden, you will see mid double-digit earnings growth coming back. And you will see the sentiment improving by September. So I'm quite confident that you have a better market by December. But timing, again, is a mug's game. We don't at all believe in it.
And neither do we want to sort of in any way try to influence retail investors or other investing behavior on this show. But let me very quickly come back to Mr. Nilesh Shah. And I have to ask you this question because obviously people want to see, political stories are made around the Sensex doing well, as you know. The opposition sort of gets very excited when things don't happen and they say, look, you said that, under us, it's a sign of great economic boom times because the Sensex is doing so well. So you understand that from a perceptorial position. So if the government were to want to sort of revive sentiment, do you think it should go in for a rate cut on loans, etc.? Because you still need capital, don't you, at the end of the day?
So Rahul, if economy could be managed with such simple things like depreciating rupee, cutting rates, then wouldn't we be the fastest growing economy in the world in double digit?
True.
But clearly life is very, very difficult. Economy is not like a car which you can start with just ignition. For RBI, liquidity as well as interest rates both matter. And they have to act like a magician to manage falling rupee, controlling inflation, maintaining financial sector stability, providing credit growth, apart from just rate movement. But just to elaborate what Ajay Bhai said, India is truly a Kasturi Mrug. Kasturi Mrug keeps on running to find where Kasturi is without realizing that it is inside her. India is exactly that. We are exporter of capital despite trillions of dollars need to build our infrastructure. Our net import of gold on official channel from 2000 January till 2021 December was about $372 billion. This is net import of about 700 tons a year, 1,000 tons import, 300 tons jewelry export, 700 tons left.
Right.
And we don't even know how much gold we have. But the first 21 years of this century, we sent more dollars in buying gold than what we received by way of foreign direct investment. And how much gold we have will come to know only when we open Padmanabha Swami temple vault and some of the safe deposit lockers in banks.
Right.
If we can monetize our gold, which is lying in Tijori, which is lying in parallel economy, then we can give augmentation along with foreign direct capital. Foreign investors will be like bankers. They'll give you umbrella when there's no rain and they'll take away umbrella when it rains. If we can demonstrate that, look, we don't need your capital. We have enough capital of our own. They'll run to us, give money to us.
Okay.
So let's focus on multiple solutions rather than just one solution.
Okay, that's a fair point. But the upshot of this conversation we've had is that, look, this is a market correction. Things will look brighter by about September. There will be a base effect and things will improve. However, all of this, of course, with the caveat that this is not meant to make anyone take a leap into the market. You still have to exercise caution, as they say. I leave it at this, viewers. Thank you very much, gentlemen.